Hello everyone and welcome to your Glassnode video report for week 21, 2023. So I will immediately apologize for the audio. I'm currently traveling and had some technical difficulties, so if you can bear with me for this episode, I am working with what I have. So what we're going to be looking at today is a really interesting dynamic where the Bitcoin network is extremely quiet, price is extremely muted, and we're seeing it really compress into a region where we just don't see this level of price compression and low liquidity and low volatility very often. Generally speaking, in markets, when you get periods of very low liquidity and low volatility, it precedes the opposite. You generally get these compressions that come before some kind of an expansion. So what we're going to be looking at is this concept and how it is playing out on chain. So we are looking at the context of there being volatility on the horizon. We know when markets tend to go quiet and when Bitcoin transaction flows get very, very light, you have these low liquidity environments where small news events, small liquidity events, whatever it is, can tend to move the price, and people then start to follow the narrative, and often these things become a little bit self-reinforcing. So we have seen Bitcoin trade within a very, very narrow price range, certainly on a 7-day basis, and we'll look at a couple of metrics describing this. But we're also going to be looking at the on-chain transaction flows from a few different levels, which gives us some insight into market depth and market liquidity. And the last thing we're going to touch on is an interesting divergence. So whilst the Bitcoin market is quiet, there's not much happening, there's not a great deal of volume going on, and a bit of a balance that we talked about in the last couple of weeks where transaction counts and all these on-chain activity metrics are actually sky high. And so what we have is that there's not much supply moving around the system. And in fact, HODLer supply is essentially at all-time highs. So we'll explore that divergence. Transaction counts are near all-time highs due to a lot of the ordinals and inscriptions behavior. But what we do not have is a lot of volume flowing around on chain. So it's a very interesting divergence, and we are going to explore these concepts in more detail. So just before we get started, please, as always, give us a rate, a share, and a subscribe. Always let me know in the comments what you're finding useful or not, and we can continue to evolve this to make sure that you're getting a bit of a view on how you can use this data to really survive in these pretty chaotic and challenging markets, and try and understand which pieces of data to use at the correct time. Right tool, right job. Right, let's get stuck into it. Okay, so here we are starting in our week on chain dashboard, and the first chart we're going to be looking at here is this 7-day price high and low. So what we're basically doing here is we're using Workbench. You can see that we've got a blue and a red band that follows price. This is essentially using one of our functions to calculate the 7-day maximum and the 7-day minimum price. So what we're really looking for here, you can almost think about this, it's kind of the same concept, similar idea to what you'll see with the Bollinger Bands, which we'll come back to very, very shortly. So what we're seeing here in the gray, note that there's these large spikes that occur, typically around volatile periods, and they typically come from relatively low periods. So what we're looking at is price compresses during consolidation ranges, the upper bound and the lower bound of the range squeeze in to get very close to each other, and that generally precedes some kind of higher volatility move. So generally speaking, we don't see these very quiet periods last for very long. Now I'm just going to bring this out onto a 5-year zoom, just so we can kind of see this in context. So again, now you can see during the bull market, these large expansions in price, right? The upper bound is climbing, the lower bound is trying to keep up. During bear markets, you get this explosive to the downside and the reverse happens. But during consolidations, look at the April top. During this consolidation, the bands squeezed closer and closer together, preceding volatility. Now you can see this little yellow bar down the bottom here. This is mapping our current level where the bands are only 3.4% apart. And really, we saw this just before the yearly open, right back here in January 2023. We saw it back here in June, July 2020, right? Both of these experienced significant moves that came off that level. We also saw it back here in November, right before the capitulation. So this doesn't necessarily give us a direction, but what it tells us is that very, very infrequently does Bitcoin get this quiet and not precede some kind of move. So we can start to expect there's likely to be volatility on the horizon. Now, I just want to jump across. This is actually a dashboard that you won't actually find live just yet. It's a little bit of a work in progress, but you will actually find a link to it in the description below. We mentioned before the Bollinger Bands, and what's really cool about Glassnode and Workbench is we can actually build a lot of these technical analysis tools. So this is a work in progress toolbox, some of the things you may be used to. Some of you may have seen these charts looking at bull market corrections. So during the uptrends, what is a typical depth of a correction that we get through these different market cycles? And you can really compare where we currently are, which by the way is quite small. We haven't really had any of these kind of major 20, 30, 40% bull market corrections just yet, which tells you something about the current market. We have the equivalent during bear markets where you have these bear market rallies measuring from the local low, how high can the market actually get? And you can see that we've had this kind of explosive rally out the other side. So, we don't really know in the future whether it's a bull or a bear market. We can certainly compare it to previous cycles to see how it looks. Now, mentioning those technical analysis tools, I know a lot of people come across from TradingView to Glassnode, and they've got that kind of initial insight into how you can use technical analysis. And of course, some people will use only technical. Some people like myself will use only Onchain. Some people like to use a blend of both. And really, it's about finding what works for you. So within the current context, what we're looking at here is a series of very popular long-term moving averages. We've got the 200-week moving average and the 111-day moving average, which both have converged directly underneath price, about 26,000. We also have the 200-day and the 1-year moving average, which have converged at a lower level down here at about 22,500. So again, it gives us a bit of a gauge where we are in the mix. We haven't spent in history much time below this red 200 week. So the fact that we're sitting right on top of it certainly makes it an area of interest to pay attention to. Now, I mentioned the Bollinger Bands before. Now, of course, we can actually calculate these. I mean, Bollinger Bands are essentially just a calculation using moving averages and standard deviation. So we can actually look at when we're getting those same compression events. And you can see this is where we saw that 7-day price back here in January 2023. The Bollinger Bands compressed at the same time that the 7-day price range compressed, and that precedes a significant explosion to the upside. Generally, markets don't like to stay quiet for very long. Compression leads to expansion, and quite often expansion will then lead to compression. Now we have a couple of other tools here, which I won't touch on too much, but we've got the classic relative strength index trying to highlight where you've got these periods of over and undersold, right, relative to the RSI levels. We've got things like the stochastic indicator, which can help you spot those crossovers, looking a bit more in momentum. And we also have the classic MACD, which is a very popular trend following tool, but just really demonstrate that we can actually build all of these tools using Workbench. And here's our 7-day and our 30-day. And you can see here the 30-day price compression is also at a relatively low level. So again, it really indicates that volatility is more than likely on the horizon. So bringing it back to the on-chain space, which of course you know that I love to do, what we're looking at here, that's kind of looking at it from a market depth, market trading, price compression, these kind of more technical analysis frameworks. Now, we can obviously bolster those concepts by looking at it from an on-chain perspective. Now, you may have seen recently, perhaps in headlines, that we've seen a couple of the large market makers, I believe it was Jane Street and Jump Crypto, have started to pull back some of their operations. And we've also got just the net overall liquidity environment based on rate hikes and the like. So as a result, this here is looking at the transfer volume on-chain for Bitcoin on the left-hand side on an entity-adjusted framework. So this is essentially going to filter out all of the internal exchange transactions and wallet clustering. It's trying to look at the cleanest data set that we can. And on the right-hand side, we're looking at the total transfer volume to exchanges. Exchanges really are a centerpiece of the industry. It's where most of the trade happens, particularly for Bitcoin. So what we're really looking at is how active is the market in terms of sending coins to and from. And you may not realize this, but on any day, the amount of coins flowing in or out of an exchange is somewhere around 500 million at the moment, which is quite low, but it can get up to several billion dollars, both in and out, in both directions, every single day. So an extraordinary sum of coins flow in and out. On net, it can be substantially lower, 2, 3, 5% of the total, but it really gives you a gauge on why on-chain analysis tells us a lot, because there's just so much coin volume going in and out every single day. But the core takeaway here, you can see this massive structural downtrend in both of these charts. Transaction volumes on-chain have continued to compress on a USD basis, and this is even despite our pretty good price performance this year. So you can see that we're essentially back down here at July, August, September 2020 levels in terms of overall transaction volume. It is very, very light, and it really speaks to that low liquidity environment. Now, likewise, when we see these kind of local lows in transaction volume, it also tends to precede some kind of volatile move. So again, there's a number of signals telling us that it could get volatile. We don't yet have a direction which way. Now, that's transfer volume, and just we're trying to unpick why there may be transfer volume that's quite low. And there's a few theses. Obviously, there's just the retraction of liquidity due to market makers and the like, trading firms. We're also coming out of what looks like a bear market. So, it's going to take some time for the interest and the awareness to regrow. But we can also look at in terms of the investors who currently hold their coins. So what we're looking at here is realized profit and realized loss, just summing them together. And you can see here the periods where profits dominate naturally in bull markets. You can see where losses dominate, the red creeps in during bear markets. You can see we've had a period of time where the profits have come back and dominated. We've covered this over recent weeks. Now, you can also note that there's just not much realized volume. Now remember, the difference between transfer volume, if you transfer 1 BTC, transfer volume is 1 BTC. What realized is looking at is, well, where did you acquire that coin? If you acquired that coin at 15,000 and you're taking profits at 26, there's a delta between your acquisition in profit, your acquisition and your disposal. Likewise, if you happen to buy up here at 50,000 and you're currently spending at 26, that delta is what we're measuring between acquisition and sale. So when you have a very, very low amount of realized value, that could also be telling you that most of the coins that are on the move are not moving very far from their acquisition price. Essentially, people are spending at or near their cost basis. Right? So that's kind of a thesis that we can take in. We know there's a lower liquidity environment, but we also know that holders may well be spending close to their cost basis, or the market hasn't been volatile enough. There hasn't been enough profit. There hasn't been enough of an incentive for them to actually spend. So we can now move across and look at, this is a great chart that we spent a bit of time really studying and building up here with me and my team. You may be aware of the realized price, which you have here in blue. It's the classic on-chain cost basis. Let's look at all of the coins in the supply. What was the average price? Now, it's a little bit unfair to do that because Satoshi, old miners, lost coins, most of those were acquired at, Satoshi had no price, but some of those were acquired at less than a couple of dollars in terms of Bitcoin price. So some of those lost coins are carrying extraordinary profits. So is it really fair for us to dilute all the extraordinary losses from this cycle with coins that are probably lost and then they're not economically active? So what we're doing with this chart in the orange is subtracting out all of the profits held by those long lost coins that haven't moved in 7 years. They're not economically active. If they spend, they will get naturally repriced into this model. What I really care about is show me the active market. Now, what you'll see is that we're trading some distance above the realized price, which is about $20,000. But remember, because we've got all these people who lost their coins and are in huge profit, that's masking all the traders who bought their coins and currently hold them at a loss. So if we subtract those out, this is what this orange curve here is. It's the adjusted realized price. And the way to think about this is the average cost basis, our best estimate, based on people who are most likely to react. Lost coins, we assume, are probably unlikely to react to volatility. People who are still waiting for their money back, who bought up here, are much more likely to respond. So what you can see is, remember, we had our 200-week and our 111-day moving average sitting down there about 26,000. Well, the average cost basis of all the economically active coins is about 25,200. So we are again hovering just above that. And if you compare the adjusted MVRV, we are still down here at levels, not quite at the bottom, but up here near the floor, that $6,000 floor we had in 2018, in the post-recovery period from March 2020, we're at a very similar level. So if you think about that, there's just not that much profit held in the system right now, which kind of explains why we had so little realized profit and so little realized loss. Because even though we've rallied 60, 70% from the lows, there's still not that much profit because people have basically got back to their true cost basis. And in many ways, the realized price is actually underestimating the true cost basis in the market, which is kind of an interesting dynamic and certainly one that I don't see too many people talking about. So you heard it here first. So with that as context, so we've got a very, very low liquidity environment. We've got not much transaction volume, not much realized transaction volume. One thesis we could take away from this is that hodlers are just willing to hodl. They haven't quite seen enough volatility, either to the downside in panic or to the upside in thank you very much for the profits. We haven't seen enough price movement yet for them to become engaged. So now we're going to look and close out on HODLer Supply. So this left-hand side chart is looking at all of the coins aged 1 year in red, 2 years in orange, 3 years in green, and 5 years down here in this white color. And all 4 of these bands are currently pushing to new all-time highs. So across the 1, 2, 3, and 5 year bands, all of these are seeing all-time highs in supply. Coins are just simply not being spent. On the right-hand side, this is our long and short-term HODLer supply, short-term in red, long-term in blue. Now, the other thing we've done here is colored the price chart. See this blue and this red zone? If you, when we talk about long-term and short-term holders, it's actually based on statistics. We look at all of the coins in the Bitcoin supply and we assess how likely are they to spend. And from our research, what we actually found is that 155 days, about 5 months, once a coin is that old, the probability of it being spent goes very, very small, less than 1% each day. Now, that doesn't mean it won't be spent, but it means it's substantially less likely to be spent. So what we're looking at here, this blue zone, note how it's just after the FTX collapse. I'm actually just going to zoom this in on a 2 year to give us a real zoom in view. So you can see here that just after FTX, the coins following the FTX collapse up to basically the start of this year, these are the ones that have just migrated into long-term HODLer supply. And look at this thing go. We're at a new all-time high of 14.46 million BTC. You can see that as long-term supply climbs, short-term supply declines because it's maturing into the older age bucket. So when we talk about short-term holders, we can essentially say that all short-term holders are from more or less 2023 onwards. That's kind of the general ballpark. But this is showing us the conviction. Hodlers be hodling. They are simply not spending their coins. They do not yet seem to have the incentive, whether fear or profit, to actually spend. So it tells us something that even though the market's pretty chaotic and even though we're coming out of the 2022 chaos and the deleveraging and all the pain that was 2022, those who acquired their coins at 15, 16,000 down here after FTX, a huge proportion of them are just simply not interested in spending right now. So it tells us something about the hodler conviction. Now, another metric that is super powerful and helps us really kind of confirm this is liveliness. Liveliness, the very simple mechanics of this is a downtrend means that hodling is the dominant mechanic. The steeper the downtrend, the more hodling is taking place. The uptrend means that there's spending. Note how it happens in bull markets. Uptrends in liveliness are the smart money getting out. People who bought in the previous bear and accumulated and held onto their coins, spending and taking profits at increasing rates during the bull. And you can see the steepness changes, tells you the behavior patterns are starting to shift. So right now we are in a very, very strong downtrend and it is currently back down to basically pre-2020 breakthrough levels. So very, very low levels of liveliness. It's showing us that hodling remains the dominant mechanic. And by and large, the market is just simply not willing to spend. So the very last chart that I want to close on, just to really put this into view, is our realized cap HODL waves. Now, these things are amazing. I use HODL waves, but particularly the realized cap HODL waves all the time. Where the HODL waves, the standard version represents the BTC volume by age band. The challenge there is that you'll see that it will show Satoshi's 10-year-old coins as a very large chunk of the supply. And as I mentioned earlier, we can probably put them to side. They're not economically active. I'm not that real concerned about what Satoshi's coins are doing. Obviously, unless they spend, then we deal with it as it happens. What the realized cap HODL waves does is it prices every coin at the dollar value when it last transacted. So the better way to think about it, this is the wealth held. What is the wealth disparity or wealth distribution within age bands? So what I've got shown here is everything from 6 months all the way to 10 years. Now, this little purple band doesn't even show up. These are Satoshi's coins. All these 7 and 10-year coins, you can barely see any purple here because they were moved at fractions of a cent, maybe even no price at all. they have very little wealth saved in them. On the other hand, our 6 to 12 month, 1 to 2 year, 2 to 3 year, which we saw on that previous chart, they are swelling and only just coming off an absolutely blitzing all-time high. So what this tells us is that the maximum volume of supply is currently held by these long-term holders, people who've been around, they've seen the volatility. Think about what you were doing 3 years ago. I can't remember. All I remember is I don't particularly remember what the price was. I have to actually go back to the price chart. On the other hand, when we look at these younger age cohorts, if you buy your coin yesterday, you probably know what price you bought at. And then if price moves up or below that, you are more likely to respond. This is where the short-term and the long-term holder behavior comes from. So really the big takeaway here is whilst the chain is very, very quiet, there's not much volume moving around, we are still seeing the hodlers just simply are not seeing any incentive to spend just yet. And pretty much across all these bands, we are seeing an all-time high in hodling going on. So at the very least, they are waiting for some kind of volatility to motivate them to do something else. So thanks everyone for tuning in for that session. Again, I apologize for the audio. We will be back up to our regular scheduled programming very soon. But hopefully you found that interesting, just looking at things from different perspectives. Be sure to check out that technical analysis toolbox. You'll find the link in the description below. Do let me know your comments and thoughts. Again, I know a lot of people come across from TradingView as kind of their first dose into looking at how we analyze markets. And really, Onchain analytics is really another view. It's another way we can actually balance, compare, and find confluence. And quite often you'll find that there is confluence between on-chain levels and key pricing levels. Why? Because human beings tend to behave the same way, no matter whether it's the 1920s, 2023, Bitcoin, gold, oil, stonks, it doesn't matter. People tend to behave the same way in markets, and that expresses itself whether it's as on-chain data or in technical analysis patterns. So until the next one, I will see you then. Cheers.